So happy to welcome back the man I was fortunate enough to have as my very first guest right here on the Income Generation, Mr. Harry Dent. I knew I wanted Harry back for the show because he's particularly renowned as an economic forecaster. In fact, in 1989, I know we're dating ourselves here, but in 1989, yes, he warned that Japan's collapse was inevitable. In the 1990s, he called the bursting of the dot-com bubble. And as early as 2006, he was sounding warning bells about the collapse of the housing market. Harry is a Harvard-educated economist, author, publisher, and highly sought-after speaker and market analyst. And I'm so happy to have him back here on the show. Harry, welcome.
Nice to be back, David.
You know, you're a man after my own heart. You got the open collar look. You know, I love that. I've sworn off the neckties myself a long time ago. And as good as you look today, I'm sure your market forecasts for next year are going to be even better. So tell us what you see ahead now over the next 12 months or so, 2017.
Well, I think 2017 is probably going to be the worst year for the stock market we've seen since 2008. And what we've really done is just seen central banks keep a bubble going one more time. This is the third stock bubble in a row. We had one peak in 2000 and one peaked higher in 2007. And now in 2015 to 16, different peaks around the world. Most of the world markets peaked back in mid-2015. And this has all been artificial. I mean, this has been companies buying back their own stock and financing with cheap money, mergers and acquisitions. That hasn't been real solid earnings, and consumers keep struggling. And the economy keeps barely growing 2%, and only because of the wealth effect created by this. The problem with all this quantitative easing and free money is simple. It creates bigger bubbles. And bubbles do only one thing in life and all throughout history. They burst. And now we've got a bigger bubble than we had before. Sure. And a lot of real estate markets that higher than they were in 2006 when they peaked and stuff. And so I see the big bubble burst again. And I think even central banks around the world, including now the Bank of Japan, Bank of England, and of course the ECB, they're no longer increasing their quantitative easing, and they're talking about pulling back from it because they're finding with negative interest rates, it actually has more harmful effects than good. We've always said you can't do this forever. You can't get something for nothing. So I think the gravy train's running out, and we're going to see stocks crash 40, 50% or more next year. And then it'll probably be late 2019, early 2020 before we pull out of a bigger downturn. And remember, the pattern is each bubble takes us to new highs, but each crash takes us to lower lows. So I'm seeing the Dow being down at least 70% in the next 3 years.
Harry, it was just about a year ago you told our Income Generation members that that's the megaphone effect. I remember that distinctly. Yeah. Now the question is, what are your thoughts about the election outcome? You know, does that slightly decrease the chances of, or the magnitude of a drop in 2017? Does it make it worse? Or is what you're talking about here bigger than politics and really have minimal effect at the end of the day?
Well, you know, politics does have minimal effects. That's why our forecasting methods work so well. We look at people and the predictable things people do as they age, spending and innovation and saving and all types of things, and buying everything from potato chips to cars to houses and stuff. And we don't look at the government as much. I mean, consumers and businesses are 80%. We also look at innovation cycles in business and technology. And we look at geopolitical cycles that affect everybody. Governments don't drive these things. Governments react to the economy and the trends we set. They don't drive the trends, except like in third world countries. Now, Trump coming in is a little bit of a wild card. I mean, one reason interest rates are rising, even though we warned that was going to happen anyway, and the markets are getting one final fling out of this, thinking, switching from saying Trump's going to wreck the whole global economy to now he's Jesus walking on water or something, and he's going to create growth and all this sort of stuff. And that this thing is too big. They have stretched this bubble now 8 years beyond anything anybody would imagine. $13 trillion worth of free money created, and pushing down bonds so far that the ECB in Japan can't even find any bonds to buy anymore. The U.S. had to taper in 2014 for similar reasons. We were pushing up our dollar. We were attracting too much capital, creating worse bubbles. So again, bubbles have their own limits, and they dive their own extremes. And so this bubble is going to burst whether Clinton or Trump wins. Trump just gets a little bit of a honeymoon from the markets here. And fortunately for him, he's not going to be blamed if the economy goes down hard, as I think it will. Hillary would have been blamed. I think in a few years from now, Hillary's going to thank her lucky stars that she lost by a hair.
A little crazy, but so in the last minute or so we have left, just tell our viewers, because I know this is the burning question in their minds, how big can this next drop be? What are you seeing?
Okay, first of all, when you get major stock bubbles, the typical crash is 80. We've seen as high as 89% on the Dow in 1932. The Nikkei's already been down 80% at worst, and it'll probably be down that again from its top. So that's very typical. I think you're going to see 70% on this megaphone pattern by late 2019, early 2020. And then ultimately, there's a kind of another couple of difficult years before demographic trends turn back up. We could see probably down 80%. But that's what people should expect. People think of corrections like, oh, 20%, 30%, even 50. No, not when bubbles burst. It's almost always at least 80%.
I always talk about the Great Depression, the 89%. And I'll ask people, I'll say, the fact that it happened once tells you what? And almost every time people say, well, it tells me it could happen again. And that's correct. So, Harry, we're out of time. Time flies when you're having fun. I really appreciate you being back. And thanks for your expert insight as usual here on The Income Generation. All right, stay with us. We'll be right back with a lot more.